Hello traders, welcome to the LFB and our global video charting review. This is for February the 8th, 2011. Hope I find you well. Please take note of the disclaimer posted to the video landing page and ensure that you've read and accepted that before reviewing the contents of the video. Global equity markets are still holding the higher ground. We're at yearly highs on the global equity market circuit, but we've still got these danger signs, although this is the new normal in dramatically low volume levels. We've got an ability to move higher, which we saw in the first credit crisis reaction with TARP and with the subprime, where equities were able to float higher because the Federal Reserve was backstopping risk. We saw it with quantitative easing programs in 2009, 2010, where equity markets, once the drip feed of TARP and subprime had been turned off, equity markets moved lower again, only to be instigated by a ramp higher with quantitative easing. One quantitative easing, one then stopped. Equity markets dropped again, only to be drip fed by quantitative easing two, which we're in the process of absorbing again now. And the reaction to these programs that the Federal Reserve is stopping the risk is that primary dealers are forced in some respect to rebalance their books. The too big to fail banks are still not lending. Lending criteria has got ever tighter. Interest rates are going higher, and the access and availability to credit, which was part of the quantitative easing program, that equity values would go higher, balance sheets would be rebalanced, bad debt would be adjusted, and lending would then increase back to levels that would stimulate an economy, and it's not working. Jobs are not getting created, interest rates are going up, equity values are going higher, but there's very few people in the market to actually enjoy the fruits of that move up. This is the Nikkei, and as you can see on the Japanese Nikkei, you do get plenty of gaps. We had a gap lower at the beginning of the previous week, but then we also got to understand as well, in this Asian session, the reason that Asian sessions don't draw in too much volume outside of maybe initial stock market movement is that we've still got the traditional lunchtime breaks where the markets actually close, and that creates a very disjointed flow. And unless there's been a very strong European and US session that Asia is then following, there's very little reason for large volume to hit during the Asian session. But we are up on the Japanese Nikkei and holding above that 10,500 swing point, which we have come to understand from a value perspective, being above 10,500 or below 10,500 on the Japanese Nikkei does give us an idea of where the market's fair value is. We're trading at 10,630, and that tells us that the Asian markets will be favouring the long side of risk on those days that European and US markets can hold equity values higher. The global equity markets are going to start to look very much the same. This is the German DAX, same thing again. We're pushing 7,300, which yearly highs, broke through the highs of last year as well, but doing it again on incredibly low volume levels. 7,200 on the German DAX is the price point that we have seen some reactions to tests of, both long and short, and until we get back to that 7,200 area, there's nothing really here that we can draw any kind of intimation from that this market will lead any others. And finally, when we look at the equity markets, we are drawn to the S&P 500, and the reason is it's the most liquid of all global equity futures contracts, and S&P 500 broke easily above the 1300 area. We got the signal on Friday of last week, just ahead of the non-farm payroll numbers. We had a February the 4th was when we got the long signal, and that was long from 13.05. Has hit the target at 13.15. That's where the upside target was, and at this point in time we will be looking for a retracement on S&P back down towards the 13.05 breakout point. If you're not already looking to be long on this particular contract, now's probably not the time to buy it. You'd be better off to see what happens when a test of 13.05 comes, because it will. And the reason that it will, there were 40% lower volume levels than the norm on the New York Stock Exchange yesterday, and that is an incredibly low volume level to be pushing all-time highs this year and having broken the highs of last year as well. Going up on light volume may be the norm that we can get away with while the Federal Reserve has put the backstopping of risk as its main mandate. You've got to watch out below when we come to test these breakout areas: 1305, 1295, 1265, 1235, 1195. They're all areas that we broke from, and we did it on dramatically light volume that we could crash straight through on the way down.